This conference will now be recorded.
Okay, and everybody, welcome again to Investing 101 with tonight's presenter, Daniel Mazzola. Thank you, Daniel.
All right. Thank you, Jessica. Very, very happy to be here. My name is Daniel Mazzola. The name of this class is Investing 101. I am an investment advisory representative with American Portfolios. I'm also a CPA. My office is in Massapequa. All my contact information is listed on the front page, the page we're looking at right now. So if anyone has any questions, if I don't cover material tonight that you're specifically interested in, by all means, you can feel free to reach out to me. A little bit of background. Again, I'm an investment advisor. I'm also a CPA. I try to handle as much of my clients' personal financial concerns as I possibly can. So that's kind of what I'm here to do tonight is to really give you a very, very basic some thoughts, some concepts on investing. As Jessica mentioned, I am not here to give specific advice on what stocks to buy or anything like that. Anybody who is here for that kind of information, I would suggest that you go elsewhere because, again, we're not really here to learn about that. I think anyone who's going to give you advice on specific things to buy, it's probably not something that you should be involved with, quite frankly, because nobody knows what's going out there in the future, and that's one of the things we're going to talk about tonight. Investing involves a lot of uncertainty, and there are ways to deal with that, and I think that's really what we're going to concentrate on tonight. So again, here's my personal information. Happy to speak to anyone specifically at another time. Again, not here tonight during the class, their specific questions and concerns. All right, so Investing 101, let's begin. What is investing? I mean, what does the investing term represent? Well, quite frankly, it's defined as the act of committing money or capital to an endeavor, whether that's a business, a project, a real estate, with the expectation of securing a profit or a material result. You're not investing to conserve your money, to preserve your money. You're investing with the expectation, with the hopes of making money. All right. The risk investing in the future is unknown. So anytime that you invest money in any particular, again, project or real estate, stock market, the future is unknown, and that's really where the risk is. Investing differs from saving in that money invested can be lost. If you're saving money, if you're just leaving it in the bank, it's not going to be lost. It's going to be there when you need it. So there's a difference between investing and saving. And again, investing, basically, you want your money to grow. If you're saving money, you're really just trying to preserve it for whatever reason. And the first and fundamental rule of investing is the greater the risk that you are willing to assume, the greater the potential return. So it's a risk and return are directly related. What that means is that if you don't want to take any risk at all with your money, then you better be just satisfied with a very, very low rate of return. Again, if you only want to keep money in the bank, you don't want to take any risk at all, then you better be satisfied with a very low return. All right, so that's really the first rule of investing, the fundamental rule, what it is all about. And again, the more risk you're willing to take on, the greater the potential returns. Again, potential being the key word. There's no guarantee with investing. The risk in the future is unknown. So there's a lot of things to invest in. We're going to spend our time tonight pretty much on stocks and bonds. You can certainly invest in real estate and land and all those kind of things, but that's not something that I do a lot of, so I'm really not in a position to give people advice. So tonight we're going to talk about investing in the stock market, investing in bonds, things like that, trying to keep it as simple as possible. What is a stock? Basically, a stock represents ownership in a publicly traded corporation. So you can invest in the local bakery, local dry cleaning, any local businesses. But if you're investing in the stock market, you're investing in a publicly traded corporation, which means that the shares are traded on exchange and trade daily. So that price could go up and down on a daily basis, and that's one of the risks that you have with the stock market. Okay, the stockholder is entitled to a proportional share of earnings, voting power, and proceeds from the liquidation of assets. But I'm pretty sure everyone on the call tonight is investing in stocks to see the price go up and maybe to get accumulate some dividends in the meantime. The voting power the proceeds from liquidation of assets is not really a concern. At least that's not why I invest in the stock market. I'm investing because I want the price of my shares to go up in value. Profits come from dividends and price appreciation. And as in with any investment, an investment in the stock market, you can lose some or all of your money. Again, there's no guarantees with the stock market. You're investing. Hopefully, you're going to make some money. You're going to make some profits, see the price go up and down, go up. But with any investment, you could certainly lose some or all of your money. All right, so that's pretty much what the stocks are. We're going to get into more details as we go on. And the other basic investments that we're going to talk about a lot tonight are bonds. Basically, all a bond is, it's an IOU. You know, you're loaning money to the government. You're loaning money to the local government, municipality, corporation, whatever it is. And in return for that loan, you're going to get interest payments, whether it's every 6 months, every 3 months, and your principal back at the end of the term. All right. So basically, again, it's a debt security similar to an IOU. It's when an investor loans money to the government, a municipality, or a corporation in return for payments of interest at a fixed rate and principal at maturity. So that's really all it is. A bond is an IOU. You're loaning money to somebody or something, some entity, and in return you're going to get interest every 3 months, every 6 months, and you're going to get your principal back, hopefully 5 years, 10 years at the end of the maturity. Okay. Bonds of higher quality and shorter terms offer lower interest rates. All right. So if you're buying a bond that's issued by a triple A-rated company, very strong in terms of their corporate history and paying interest and payments on a timely basis, then you're not going to get as high an interest rate as if you buy something with a little less credit worthy and certainly a longer return. And again, it goes back to what a bond is. It's an IOU. If you're loaning money to your friend across the street and he says he's going to pay you back tomorrow, well, you're going to get a lot less money than if he says, I'm going to pay you back in a year from now or 2 years from now or 5 years from now, all right? So the interest rate that you receive is based on the length of the loan and also the credit quality of the person you're loaning money to. So if you have two friends, one of your friends is very financially strong, you know you're going to get your money back, you're going to get less of an interest rate from that person than the person who maybe is in and out of a job and is not as credit worthy. So that's really the how the interest rates are determined. Again, the length of the loan, the length of the term, and also the credit quality of that person you're loaning the money to. And the most important thing with bonds is that they are subject to what's called interest rate risk, which means that the market prices will go up and down based on what the prevailing interest rates are. And all that means is that if you get a bond that pays 4 or 5%, let's say it pays 5%, you're getting a bond that's paying 5% from a fairly strong company or a government, municipality, whatever it is, you're getting 5%. And new bonds come out, and the new bonds issued by that corporation, municipality, whatever it is, are now paying 6%. Well, your 5% bond is going to look as good as the one paying 6%, and the bond value will go down. All right, so bonds are subject to interest rate risk, which means that the price of the bond could go up or down based on what's happening with current interest rates. As long as you hold your bond to maturity, you know you're going to get your money back. But by the same token, that doesn't mean the price is fixed. The price will go up and down based on, again, prevailing interest rates.
Daniel, we have a question that came in. Somebody wants to know, how do you get a government bond?
That's a good question. And actually, we talk about treasury bonds in a few slides, so that we will cover that. But that's a good question. All right. Is that okay if we move on?
Absolutely. Yep.
All right. Thanks. But feel free to interrupt me at any time. That's up to you. I'm leaving that to your discretion. Okay?
You got it.
All right. So we talked about investments and bonds and stocks. And when I was developing this presentation, I really didn't know what order to put things in. So I said, you know what? After the first 2 or 3 slides, when we cover, I think, the most important topics and how we're going to detail or develop them, everything else is going to come alphabetically from here on in. So I'm going to, some letters are a little stronger than others, quite frankly, but I try to cover each letter as best I could. So with that being in mind, let's talk about annuities real quick. An annuity is what as basically another a term for a lifetime annual cash flow. And with an annuity, what you're doing is you're exchanging a lump sum for a series of yearly payments or monthly payments guaranteed by a financial institution. The institution bears the risk of providing the stream of income. What that means is that you're giving money to an insurance company or a bank or a brokerage company, whatever financial institution is, and in return for that pool of money, they are giving you a stream of income. Again, whether it's monthly, yearly, for your life, whether it's 10 years, 20 years. That's all an annuity is. So people who are buying annuities, I think, quite frankly, as somebody in the business, annuities are sold in a lot of inappropriate places, inappropriate times. Basically, you should think of an annuity as something that's going to provide you with income. And if you need that, then it's a product that you can use. And if it's not something that you need lifetime income for, maybe you already have a pension or Social Security or something like that, then there are better products out there. So I always ask when I give a presentation like this, who in the audience has an annuity or has heard of an annuity? And I'm always amazed people raise their hand. Unfortunately, most of those people can't give me what I would think is a good explanation of what the product is all about. So the next time somebody says what an annuity is, now you have the answer. You're giving a pool of money into a financial institution, a bank, an insurance company in return for cash flow, whether it's lifetime annual cash flow or monthly cash flow, whatever it is. But that's all an annuity is. And again, I think that's the only reason you should be buying an annuity, for that annual cash flow, knowing that it will survive your lifetime. It'll be there when you need it. All right. Again, a lot of information I'm going to try to get across to you in the next 45 minutes or so. I'm going to go through some things very quickly. Feel free to reach out to me for more details. All right. So we talked about annuities.
Well, we have another question real quick.
Oh,
And
okay. Well, there you go.
You might be covering this in a few slides.
Jess, what was the question? Jess?
The question was, what would you recommend instead of an annuity?
What would I recommend instead of an annuity? Well, it really depends on the situation, An annuity would be appropriate if you need something to give you, again, lifetime annual income. So a lot of people out there, they don't have pensions on their own, or maybe they have Social Security, which is a small amount. Then I think an annuity product is appropriate. But if you already have lifetime income, whether it's from a pension or Social Security, I think there are better vehicles out there. Just mutual fund investment in terms of investments, just buying mutual funds and things like that. Again, I've been in this business for a long time. I see annuities sold in instances where they shouldn't be sold. It's a very high commission product. It's very difficult for the person, the annuity buyer, to get out of the product if they decide that they don't need it for whatever reason. So there are better products out there, but that really depends on the situation. And that's something, again, I don't want to spend time on specific situations for people tonight. I'm happy to answer that at another time. Okay?
Thank you.
All right. So we talked about, let's see, we had an A annuity. We already had a B for bond. So let's talk about compound interest, all right? This is one of the fundamental rules of investing, the power of compound interest, all right? So let's look at two examples of the power of compound interest. We have an investment of $1,000. The rate of return is 2%, which is what you get maybe with a bank and a CD if you went out very far, 10 years, 15 years. I don't know of a lot of banks that are giving 2% rates of return at this time. Anyway, if you are able to get that 2% rate of return over 30 years, that's what your balance will be, $1,811. So you haven't had a lot of growth with the 2% rate of return over 30 years. But that same $1,000 invested in something that's going to give 8% over 30 years, now you're looking at over a $10,000 balance. So there's a big difference between earning 2% on your money and earning 8% on your money, especially as you go out further and further, 5 years, 10 years, 15 years. In this case, we have 30 years. Where are you going to get an 8% rate of return? Well, that's tricky. You're going to have to go out and take some risk. You're going to have to go out and invest in the stock market and things like that, all right? I can't guarantee you that you're going to get an 8% rate of return, but certainly you have a much greater chance of doing so in the stock market than keeping that money in the bank, all right? But again, there's no guarantees. It's not going to go up in a straight line. You're going to have good years. You're going to have bad years. So that's one of the examples of compound interest. Let's look at another example of, again, the power of compound interest. We have a woman named Sarah. She has invested $1,000. She's gotten a rate of return of 7.2%. If she starts at age 20, at 50 years, when she's 70 years old, she's going to have $32,000. All right, so that's 50 years of compound interest, 7.2%. That $1,000 has grown and grown and grown. But look what happens if she starts 10 years later. She's got half of that. She doesn't have 32,000. She has 16,000. And then the third example, if she's starting at age 40, she now has only 8,000. So here's an example of the power of compound interest. The earlier you start, you're letting that compound interest work for you, growing and growing and growing. So when I talk to young people about investing, I always stress to them it doesn't matter how much you have to invest now. The most important thing is to get started. Whatever amount you have, $500, $1,000, whatever it is, that's the most important thing. You can see the big difference between somebody starting at 20 versus somebody starting at 30 or 40. So any young people on the call tonight, my advice to you is to get started as early as you can. Don't get hung up on the amount of money that you may or may not have, $1,000, $500, whatever it is. Whatever it is, the most important thing is to get started and get that compound interest working for you. Okay? All right, so let's talk about D is for diversification, very important term in the investment world. All that means is not having all your eggs in one basket. You're going to have lots of different things, different holdings, different areas, different sectors. Again, not having all your eggs in one basket. A portfolio having non-correlated assets, which means assets that are not related. One's going to go up while the other goes down, is the best way to reduce risk and avoid a significant decline in the portfolio's value. The people that get hurt in the stock market have all their money in one stock or one mutual fund or anything like that. If you're diversified properly, you may be not going to make as much money on the upside, but you're protecting yourself against, again, a downside, losing all your money. The people who are well diversified are able to take the downsides, the downturns, much better. All right? Means owning a vehicle not performing well, perhaps even poorly. The objective should not be picking a winning stock or a mutual fund, but building and maintaining a portfolio that will deliver a solid return over a long period of time. All right. So a properly diversified portfolio, every year there's something that's going to be there, most likely, that hasn't done poorly, hasn't done well. Last year, for example, for most of the year, there was a segment of the stock market, little tiny micro stocks, which did not do very, very well until almost November or December. And this year they have done extremely well. All right. So the smart investor at the end or in the middle of last year, maybe around September or October, would not have taken money out of his stock or mutual fund that was doing poorly. He would have certainly held on to it or maybe even added to it. All right. So the point of this slide is, again, if a properly diversified portfolio is going to have lots of different things, 8 or 9 different sectors, categories, the one that's doing poorly, or if you have a couple, doesn't mean you get out of it. It means you stay into it and you hang on to it. And if you're really smart, you're going to add money to that, the one that's doing poorly, because eventually it will come back. All right. So that's the D slide. D is for diversification. All right. The E slide, we're going to talk about earnings and emotion. Basically, the stock market fluctuations is based on 3 things. Number one, it's based on corporate earnings. You want to be invested in something where the company's doing well. Obviously, their earnings are growing. All right. Number 2, interest rates. The stock market is based on corporate earnings and interest rates. As interest rates are very, very low, the stock market's going to be very attractive. But if interest rates start going up and you can get a lot of money on your money that you have invested in CDs at the bank and things like that, you're not going to go out and take the risk in the stock market. Why would you? If you can get an 8% rate of return on a CD in the bank, you're not going to put your money in the stock market, or maybe you will some of it. But with interest rates very, very low now, historically low, it makes going out in the stock market that much more attractive because you want to get some returns. So interest, again, the stock market is based on corporate earnings, interest rates, and the last thing that I have is emotions. if people are feeling very scared, very apprehensive about the future, like we were back in March and April of last year, right, when the coronavirus was breaking, the stock market went way, way down. Everybody was real scared about what was happening. As the year went on and some of the vaccines were introduced, it looked like some businesses were doing better than others. The stock market came back, and now it's at record levels because everybody is thinking that 2021 is going to be a very strong year. Things are going to come back, maybe not in the next couple of months, but maybe by the second half of this year, things will have come back, return to normal, and they don't want to wait until then to start investing. That's why the market has done so well the last 6 or 8 months or so. All right, so somebody once explained to me, and I think it makes a lot of sense, the stock market is really based on two things, the earnings and the interest rates, and I added the emotions on my own just because working with people on my own, I see sometimes they're scared and they pull money out of the market. Sometimes they feel very confident about their own future or the future of this country or the future of the economy, and then they put money back in. So it's really based on what people's emotions are as well. All right, so that's the E slide. Let's go to F. A lot of times people are reading the Wall Street Journal and watching CNBC and things like that, and there's always people that are coming on who are making forecasts. All right, as investors, we like to hear what the people making forecasts have to say. All right, investors pay millions of dollars each year to analysts, strategists, and experts, each of whom is claiming to have some insight in the future. People do this in a desperate attempt to find some certainty in an unknowable future. All right, so we like to hear people who are making forecasts. We like when somebody comes on TV and feels very confident about what's going to happen in the future. But a lot of times these people don't know any better than you do. All right, so I'm very leery when people call me up saying, I heard this on CNBC, somebody said this or somebody said that, this expert, that expert, whatever their qualifications are. A lot of times they're doing it just to make a name for themselves. They don't know any better about what's going to happen in the future than you or I do. So I'd be very wary about making investment decisions based on somebody's forecast about what's going to happen in an unknowable future. All right. Examples of common forecast, 5 hot stocks to own for 2021. Widget companies' earnings are expected to grow at 25% for the next 5 years. And this is one that I heard when the president was elected first in 2016, and then a couple months later when he looked like he was not going to get elected, and I heard people say, well, the stock market's going to go down, Trump is leaving office, and whether or not you like Donald Trump, we're not going to talk about that tonight. That's a subject for a totally different day. But these are the kind of forecasts that people say, and as anybody who's paid attention in the last 3 months, the stock market has not gone down since Trump lost the election. It's gone on to greater heights. So I'd be very, very, very wary about people making forecasts and basing your investment decisions on those forecasts. That's the F slide. Jess, how are we doing with time? Did you want me to finish up by a certain time, Jess?
No, you're good. You can keep going.
Oh, all right. So you want me to talk to 10 or 11 o'clock at night tonight?
As long as everyone stays, we're good.
All right. Have I lost anybody yet?
No, in fact, more people keep coming in.
All right. Well, that's good. So let's keep going. All right. Now, the G slide, if I can get to it. All right. This isn't really about investing so much. It's just, I think, being financially prudent, let's say. Okay. I'm a big fan of setting goals. I set goals for myself personally, career-wise, professionally, lots of different goals at the beginning of the year. So since it's only January the 13th, I think it's a good idea to set goals for yourself for the rest of this year. And the idea of setting a goal is that it will lead to improvements in daily habits. Now, I teach a financial fitness class. Maybe we can do that someday for this library. I'd be happy to do so. And that's one of the things I talk about during that class is setting goals. Why is setting goals so important? Because it leads to improvements in daily habits, all right? The objective of any goals should be ambitious enough to motivate, but not too high that it is unattainable, all right? So when you set a goal, you want to set it so it requires some kind of effort, but not too much effort because then it's unattainable and you'll never get there, all right? break down goals into improvements of daily habits. All right, so we talk about goals, maybe saving $50 a month. So you could wait until the last day of the month to come up with $50, or you can say, you know what, I'm going to save $1 here, $1 there, maybe a couple dollars each day. So by the end of that month, that's where the $50 comes in. All right, the whole idea, again, setting goals is to improve your daily living habits. And here's some identify the reason for the goal, write it down. Why are you saving money? Is it to save for a vacation or buy a new car or a new house or whatever? Always write down the reason for the goal. And here's some financial goals, again, that I talk about during that class. Saving $100 a month is a good financial goal. Improving your credit score, another good financial goal. Winning the lottery, however, is not a financial goal. That's just based on chance, all right? So while setting goals maybe is not particularly specific to this investing presentation, I do think it's a very important as a financial fitness, something you should be doing every day. So that's why I included it in this presentation. And again, I think that's very important as a way to improve your daily habits. So I hope people don't mind me just kind of sticking that in right there. All right, so we reached the H slide, and the H is for hedge funds. And we'll talk about a hedge fund is a limited partnership of investors that uses high-risk methods in hopes of achieving superior performance. Okay, people who are investing in hedge funds are not satisfied with getting the regular returns from the stock market, the S&P or the Dow Jones. They want to get better returns, so they're willing to take more risk, higher returns and or positive returns in up and down markets. So basically the idea of a hedge fund is to do better than the overall market or to make money when everyone else is losing, all right? Able to make extensive use of complex trading, portfolio construction, and risk management techniques. So the average hedge fund professional manager is going to be able to do a lot of fancy things. He wants to get that extra performance. So what is he going to do? He's going to borrow money, and he's going to short sell and use derivatives. Lots of fancy, sophisticated techniques. All right. But that being said, the average hedge fund is not able to beat the market on a regular basis. So you're paying extra fees. You're having your money tied up. You can't get at your money whenever you want in a hedge fund. A lot of times they're illiquid. They'll only allow you to get out at certain points during the year. All right. So I bring up the hedge fund slide not as a proponent of hedge funds, but as one that I think it's not appropriate for the average investor. I would think that the people on this class, quite frankly, should concentrate on the mutual funds, the things that are available to them without getting involved in hedge funds. I don't think it's a good idea, but I wanted to cover it in the class for the reasons that I mentioned. You're taking on extra risk. You're paying higher fees to hopefully find a manager who's going to do better than the market, but most of the hedge fund managers fail to do so, and they wind up going out of business in a couple of years and losing all their clients' money in the meantime. All right, so let's talk about IRAs accounts again, and not necessarily an investing term, but this is a good way for people to save for retirement. If you don't have a 401k or a 403b at your office, at your job, then you should be putting money into an IRA account. You must have earned income to put money into an IRA account. The limits for this year, it's $6,000 with a $1,000 catch-up. So the reason I put the IRA slide up here is, again, just to be people in the audience, if they don't have money in a 401k or they don't have access to a 401k or a 403b, you want to save money for retirement, then this is the way to do it. And it's very simple to set up IRAs. You go to the local bank or whoever it is. But again, this is for people who don't have something through the job. This is a way for them to save for retirement. All right, another slide, we'll talk about index funds. We just talked about hedge funds as being very sophisticated. The index funds are almost the direct opposite. This is a fund designed to follow preset rules to match or track a specified basket of underlying securities, such as the S&P 500. So all you're doing with an index fund, you're putting money into something that's going to match an index, whether that's the S&P 500, the Dow Jones Industrial Average, with the expectations that you're not going to beat that index. You're just going to match it. Whatever the index is doing, that's what you're doing. And this is, I think, the way for most people. The average investor should be using index funds. They're low cost, they're low operating expenses, broad exposure, very diversified. So this is what I think, again, the average, this is what we use for our clients for the most part. And I think people starting off just very basic investing, and that's what the class is all about, Investing 101, they should be using index funds. Keep your costs low, and the returns will be much higher if your costs are lower. And that's the whole idea about buying an index fund. You're not having something that's professionally managed. They're just tracking whatever is in the index when they build the fund, and that's what you're getting. And like I said, I think that's what the people in the class, they should be focused on, index funds when it comes to investing their personal money.
So real quick, going back to the IRAs, somebody had a quick question, why a 401k is better than an IRA? And if a job doesn't match your 401k, what pros does it have over the IRA?
Well, the 401k or 403b is going to allow you to put a lot more money away. You know, on this slide, you look at the amounts that you have, and I apologize, and I should have updated that. But with an IRA account, you're only going to be able to put away $6,000, and they give you a $1,000 bump up if you're over the age of 50. But if you're in a 401k or 403b, those are much, much higher limits. For example, I think it's 19 or maybe even 19,500 for somebody to put money into a 401k this year. And that's without the bump up. You know, I think there's a $6,000 bump up. So if you have a 401k or 403b at your job, A, you're going to be able to put away a lot more money, and B, they may have a match. And if they have a match at your 401k, then you have to put away at least what the match is. If the match is 3%, 4%, then it's almost a layup. You'd be crazy not to put away at least what the match is. So those are the two advantages real quick. Again, you're going to be able to put a lot more money with a 401k than an IRA. And if you're lucky to work for a company that has a match, I mean, that's a huge, huge benefit. So that's the reasons why 401ks are better. If you have an opportunity to use a 401k, that's what I would recommend. A lot of people don't work for a company. Unfortunately, they work for a company which doesn't have a plan, and then they're forced to use the IRA.
Thank you.
All right. Good question. I like the questions. All right, so we talked about I, index funds. Let's talk about J. J is for junk bonds, or I hate to use the word junk, but I had trouble coming up with the J slide, so that's where this came in. Anyway, a junk bond is really just another name for a high yield bond. And a high yield bond is one that's rated below investment grade, has a higher risk of default or other adverse credit events. Basically, there's a higher risk that the issuer might not be able to pay the interest and principal when it comes due. So with a junk bond, you're getting a higher yield and a better quality bond to make them more appealing to investors. You're not going to buy a junk bond if it's paying the same rate of return that a good bond is paying. So the junk bonds offer a higher rate of return. So again, I'm not crazy about that term junk because I think that denotes a lot of things out there when it could be just a bond that's not as good. Again, below investment grade doesn't necessarily mean it's a horrible company. It just means maybe it's a new company or a growing company or a company that's having temporary problems. All right, so you want to do a little extra homework, obviously, but I don't think that you want to necessarily just ignore them. They might be worthwhile anyway. You are getting a higher rate of return for the risk that you're taking. All right, so let's talk about tax loss harvesting. If you are investing in the stock market, there'll be times when you have losses, and what you want to do with those losses is you want to harvest them for tax reporting purposes. And all that means is you're selling securities at a loss to offset the gains in the portfolio and $3,000 of ordinary income. All right, so when the next time the stock market goes down, you want to look at your portfolio. You want to sell the stocks that have losses. And why? Because you take advantage of those losses. You use the losses to offset the gains, and you can offset $3,000 of ordinary income. After a month goes by, you just buy the stock right back. That's actually 31 days, all right? And after 31 days, you can buy it back, and hopefully the price hasn't stayed relatively the same. You just buy it right back. So I don't see a lot of people take advantage of this tax loss harvesting. They should. Every time the market goes down, you want to look at your portfolio, say, I'm going to sell this, take advantage of the capital loss. I can always buy it back again after 31 days. If you do have losses that are unused, they just carry them forward indefinitely, all right? But you can use those losses again, A, to offset gains, and then B, to offset $3,000 of ordinary income. Now, that doesn't sound like a whole lot, $3,000, but believe me, it's worthwhile, especially depending on what tax bracket you're in. So the next time the stock market goes down, take advantage of the capital losses, tax loss harvesting, sell those positions, and just buy them back a month, 31 days later. All right, so we are on the M slide, and M, we're going to talk about mutual funds. We have two M slides, all right? The first one is mutual funds. All a mutual fund is, it's a way for the smaller investor, the individual investor, to pool his money with other smaller individual investors and buy lots of different stocks, all right? If you go out with, let's say you have $1,000 and you want to buy 100 different stocks, you're not going to be able to buy that on your own, but you can do that with a mutual fund, all right? And that's the whole idea. You're buying lots of different things. You're pooling your money with other investors. The whole idea is to diversify your account, get lots of different positions, all right? Portfolio is designed to maintain and match the objectives established. So maybe you have a mutual fund that buys only large cap stocks. Maybe you have a mutual fund that buys only international stocks or emerging market stocks. There are thousands and thousands of mutual funds out there, so you want to find the one that fits your needs at that time. Is it appropriate for what you're looking for? Again, there are mutual funds that invest in stocks and bonds, combinations, everything. Right now, the way the investment world is structured, there's, again, mutual funds for pretty much everything. Mutual funds give the individual investor access to a diversified portfolio at a much lower cost than he or she would be buying those individual issues. And that's the whole idea with the mutual fund. There is an expense ratio. That's what you're paying the manager, the plan sponsor. So be aware of those mutual funds that have high expense ratios. I'm not saying they're not any good, but you want to do your homework if we were buying a mutual fund with a high expense ratio. And I included the two familiar names when it comes to mutual funds, Vanguard and Fidelity. I'm not saying that they are the best. They're certainly the most largest probably. I know Vanguard accumulates probably more money than anybody else in the mutual fund universe. So those are the two probably most popular or well-known mutual fund sponsors. But there are lots of out there, and you have to do a little homework, make sure the one that you're buying is appropriate, and again, not too expensive. All right, the other slide is municipal bonds. So we talked about bonds, we talked about junk bonds, we're going to talk about treasury bonds a little bit. Now we're going to talk about mutual bonds, municipal bonds issued by state and local governments to finance capital expenditures, roads, bridges, things like that. Basically, again, it's a loan. We talked about a bond being an IOU. You're loaning money. In this case, you're loaning money to the state or local government so they can use that money. And municipal bonds, the attractiveness of municipal bonds is that they are exempt from federal taxes. And if you buy a New York State municipal bond, it's going to be exempt from New York State taxes as well. All right, so that's the whole idea of buying a municipal bond, is for the tax-free interest. All right, so it really depends on what tax bracket you are. If you're on a high-income taxpayer, then the municipal bonds are going to make much, much more sense than if you're in a low-income taxpayer. So again, if you're paying a lot of money in taxes, then I think muni bonds are something that's an attractive investment. If you're not paying a lot of taxes, and again, if you're in a low-income tax bracket, don't bother with the muni bonds. The tax advantages aren't that special. Again, aren't as valuable to you.
We had a question. How do you get a municipal bond?
Well, there are commercials for municipal bonds. So if you're working with a financial advisor, they should be able to help you, obviously. But there are questions. There are commercials that come up now and then on Bloomberg and the different radio stations where the let's say New York City or New York State advertises directly to people out there about municipal bonds. So that happens too. So you just have to be aware. If you're on your own, you're not working for with a financial advisor, then you're going to want to read the different papers and financial news and things like that to pick up on the muni bonds, the new offerings. Okay, that's for somebody who's working on their own. if you're working with a financial advisor or with a Schwab or Ameritrade or something like that, they should be helping you buy muni bonds. All right, but again, that really depends on your situation. If you're not working with somebody and you want to do it on your own, then it's really just a question of paying attention, reading the different papers, because the different issuers will come out when they have a new bond. They'll advertise it in the Wall Street Journal or the New York Times financial section, things like that.
Thank you.
All right. So we talked about forecast a little bit. Noise is another investment term I like to use anyway. And basically, noise is defined as loud or senseless shouting. As an investment term, noise is meaningless data that misrepresents underlying trends and distracts a person from his or her long-term objective. Okay, most noise is negative, as our brains are wired for bad news. Common form is hypothetical or expert opinions. So we talked about forecasts a little while ago. Again, you want to be careful as an investor to avoid noise. If you're watching CNBC or any of the other programs, a lot of it is loud noise, people making forecasts, predictions about what's going to happen. They don't know any better than what you do. So you have to be careful as an investor to not make the noise affect your decisions. And if it is, then I would strongly urge you to, again, stop watching CNBC or whatever else. I see too many people who call me up, say, Danny, you know what I heard on the news last night? Or I'm scared because somebody said the market's going to fall 50% tomorrow. Whatever it is, whatever the reason is, again, you want to tune this out. It's not helping you as an investor. It's only hurting you. The people who are successful investors are not getting in and out of the market based on what they hear on TV or read in the paper. They're sticking with it through thick and thin. All right. So I try to get our clients to limit watching the CNBC, the shows, or any show, quite frankly, that makes predictions. You're only going to get scared. It's going to upset you, and it's not helping you. All right. So try to tune out that noise. All right. So let's go to the O slide. We have a couple of O slides. Options, number one, the O slide. Basically, an option is a contract for which conveys to the owner the right, but not the obligation, to buy or sell an asset or an instrument at a specific price. I don't want to get too complex. Options are for sophisticated investors for the most part. I don't encourage using options if you're just starting out. You can use them. They can be used for income speculation and to hedge risk. So there are people that use options to hedge their risk, which I think is fine. All right, but a lot of people use them as speculation, and they wind up getting hurt because options are very expensive, and there's a lot of extra, knowledge or things that are built into the price. So be very, very, very wary. If you are using options, I don't encourage them to do so. Real quick, a call option gives you the right to buy. A put option gives you the right to sell. So let's say you buy a call option on Apple, gives you the opportunity to buy Apple at a price in the future. You're not obligated to buy it. It gives you the right to do so. You're buying the option hoping that the price of Apple will go up, and that makes your option more valuable, and you can then go out and buy the shares of Apple at a lower price, all right? So I don't want to spend too much time. Again, I think it's a little too sophisticated for this Investing 101 class. That being said, if somebody is using options or wants more information on them, how they should be used, when they should be used, feel free to give me a call. I'm happy to help out. The other O slide I think I want to talk about is a little bit more relevance. And again, I see this all the time. People are overconfident when it comes to investors, especially after a year like we had last year. I saw a lot of people buy stocks like Tesla, and they went up 6 or 7 or 8 times, whatever it is. And now they think they're tremendous investors. And I'm not saying that, congratulations on making a lot of money on Tesla. But just because you picked one winning stock does not mean that you are a good investor. Maybe you're just lucky. And that's the whole point. I see too many people have overconfidence when it comes to investing. They attribute their successes to their own skills, again, rather than luck. And I see this far, far too often. People overstate their ability to make predictions about the future. What are the consequences of being overconfident? Well, first of all, it's going to probably put you in a position where you're doing a lot of trading excessive trading, again, trading going in and out, thinking that you know something that the average person doesn't. So it's going to have you trade a little bit too often, maybe fail to diversify. Again, I used that example of people with Tesla last year, made a lot of money on Tesla, forgot about diversifying, and put all their money in one stock. Again, they had a great year. They've had a great year so far this year. But at some point, I think it'll come back, and you want to be careful of that. And finally, it leads to insufficient retirement planning. Why? You're so confident of your abilities and you fail to plan accordingly. Maybe you're not putting as much money away as you should be because you think you can make it up in the stock market. So again, be careful of being overconfident when it comes to investing. Try to realize that some of your success might be the result of luck rather than skill. Okay? All right, so we're on the P slide. We're making great progress here. The P slide I'm going to use is for a PE ratio. This is a measure of the share price relative to net income. Okay, and basically a high PE ratio generally increased demand because investors anticipate earnings growth in the future. Okay, so any stock with a high PE ratio, and I just used Tesla as an example, is vulnerable to bad news. All right, so let's talk about Tesla right now. The Tesla is priced as if the growth is going to continue forever and ever and ever, and things are going to go well forever and ever and ever. And at some point, things are going to slip, and then the stock, because it has such a high PE ratio, is now vulnerable to bad news that doesn't meet expectations. All right, so you just have to be aware when you're picking stocks. And again, I hate to harp on Tesla, and I apologize to anyone who has Tesla if I offended them in any way. But any stock with a high PE ratio, you have to be a little wary that means that any kind of bad news or bad predictions or anything bad, that stock is going to be a lot more vulnerable to a price decline than something with a low PE ratio. And I think that's the best way to look at it. Again, a high PE ratio means it's priced for perfection, priced for very, very good news. Any kind of bad news that comes along, you're going to see that stock take a little bit more of a fall than if it had a lower PE ratio. All right, qualities of a good investor. I like to use this slide for my financial fitness class, so I think it's very appropriate for this presentation as well. Basically, some of the quality a good investor has is that good investor is patient. He knows that things don't happen overnight. Sometimes it might take a few years for that investment to pan out. So just because the stock doesn't go up the day after you buy it doesn't mean that it's a bad stock or a bad investment. You want to hold on to it, all right? So you want to be patient. You want to have some resolve, all right? You want to stick it out. There'll be times when the market is down. It doesn't mean you sell. It means that you maintain what you have, maybe even buy a little bit more, all right? So you want to have some resolve. You want to have some courage, all right? It's not easy to be an investor in the stock market or any kind of investor, quite frankly, especially when things are going down. The best example of that is March and April when it went down. I think the market went down one day over 3,000 points. Believe me, that was not a fun day for people who invested in the stock market. But you know what? It came back, and look where we are a year later. All right, so you have to have some courage to be a good investor. You have to be self-aware. All right, if you can't stomach the ups and downs, if reading your monthly statement is really going to bother you to see losses, then maybe you shouldn't be in the stock market. All right, maybe you're not cut out to be that kind of investor. Not everybody is. It's not a bad thing. But again, have some self-awareness when it comes to being investing, knowing that it doesn't go straight up, and you're going to have some times where you're going to have to take losses, accept those losses. Finally, use a little common sense, all right? If somebody comes to you as an investment or advisor or a stockbroker and says, I can double your money in a week or a month or whatever they sell, again, anybody who's promising you things that are unrealistic, it's up to you to use a little common sense. And you know what? That doesn't really make sense. I'm only making 1% of my money in the bank. How are you guaranteeing me 8 or 9% or 10%? You know, again, use a little common sense when it comes to investing your money. If people are promising you things that aren't reasonable or appropriate, then you want to stay away from those. All right? And those are the qualities of a good investor. Okay, so we're on the R slide. I am a big fan of rebalancing. And all that means is that for those with an investment portfolio, you should establish a target allocation, have some money in stocks, some money in bonds, 50%, 80%, whatever the percentages are. And then you want to rebalance when those percentages are out of whack, they're out of alignment. So let's say, for example, you say when you set up your portfolio, you're going to have 50% of your money in the stock market, 50% of money in the bond market. And after last year, you now have 60% of your money in the stock market because it did so well. Now is a good time to rebalance. Again, it forces you as the investor to sell high and buy low. The people who are rebalancing on a regular basis are much more successful than the ones who just leave their money there without looking at it. I'm not saying rebalance every day or every week, but I think you should be rebalancing at least once a year, and if circumstances dictate. Let's go back to what happened in March and April of last year. The market was way, way down. And for people who rebalanced at that time, who took money from the cash or the bonds, who put it into the stocks, they are very, very happy they did so, all right? So we're big fans of rebalancing at my office. What I do with my clients, I encourage it for everyone. They should be rebalancing at least once a year, or if circumstances dictate, look what happened back in March and April of last year. And I would be rebalancing right now. Again, I bet you if you look at your stock weighting, it's probably a little higher than where it normally would be or where it should be. Now's a good time to say, hey, you know what? I've had a pretty good stretch. Why don't I rebalance, take some off the table, take some of my profits? Again, it forces you as an investor to sell high and buy low. All right. All right, the S&P, this is for 500. We already had the S slide back for stocks, but I added another one here. The S&P 500 is a stock market index that measures the performance of the 500 largest traded companies in the U.S., along with the Dow Jones Industrial Average, the most commonly followed index, and the top holdings are Apple, Amazon, Microsoft, the big banks. Again, this is all the big companies. So when you hear that the stock market was up or down today, normally it refers to either the S&P 500 or the Dow Jones Industrial Average. The Dow Jones is only 30 stocks. The S&P 500 is 500 stocks. So it's a much, much, much better indicator of what the stock market is doing. All right. So if you are going to follow something, my advice, my strong advice, is to follow the S&P 500. The Dow, again, doesn't mean as much. The Dow is only 30 stocks. The S&P 500 is 500, much better, a better section. All right, moving along here, we are now going to have the T slide, and the T is for time in the market. Time in the market is a strategy of making buying or selling decisions by attempting to predict future market price movements. All right, you're going to say to yourself, well, I think the market's going to go up or down, so I'm trying to time the market. I'm going to go out and try to get back in. All right, so I don't encourage people to market time. I think it's very difficult to do it on a regular basis to be successful. You might get lucky and pick the right time to buy or sell, but it's very, very, very difficult to do both. I know a lot of people who got out last year and are still waiting to get back in. They're trying to market time, all right? So market time is much different than rebalancing. Rebalancing is just taking a little bit of your profits occasionally. Market timing is selling everything or buying everything. It's really turning over the whole portfolio or a large chunk of it anyway. So you want to avoid market timing. A forecast may be based on an outlook for market or economic conditions resulting from technical or fundamental analysis. Again, this goes back to the experts and the analysis, making predictions and forecasts and things like that. With the market timing, it's difficult to correctly time the market twice. When to get out is usually much harder than when to get back in. All right, so with that in mind, I'm not a big fan of market timing, but rebalancing, which is, again, selling some of your portfolio, taking some profits, I think is a good thing. Market timing is not. All right. This is my part of my financial fitness class. Again, not necessarily for the investment class, you might think, but I think it has relevance. Anytime you have a chance to invest in a tax-deferred basis, whether it's an IRA or a 401k or whatever it is, you're much better off than using just a straight brokerage account, okay? So we talk about marginal tax brackets, marginal tax rates, In the U.S., we have a progressive tax system. Higher income means higher tax rates. Marginal tax rate is the rate that applies to the last dollar of income. Knowing your tax bracket and the marginal tax rate helps you to assess the tax bracket of your financial decisions. So for those people out there who are thinking about putting money into a traditional IRA or maybe a Roth IRA, it helps to know what your tax bracket is, what your marginal tax rate is. If you're in a low tax bracket, then the IRA deduction maybe doesn't mean as much to you than if you're in a higher tax bracket. All right. So the idea is that taxes should be affecting your investment decisions. If you have a chance to put money away in a tax-deferred vehicle, an IRA or 401k, that should be your primary vehicle, your primary instrument that you use. All right. Lock up or max out on the 401k, max out on the IRA. Then if you still have money left over, then you put it in a brokerage account. But that should be your first vehicle. Again, anything that's tax qualified, tax deductible, tax advantage, that should be the one that you're using for your investment vehicles. All right, so that's the two. We had 2 T slides. Very good. All right, I'm going to have the tax brackets here. All right. Update your beneficiaries. Update was my I had trouble with the U slide. So basically, if you do have an IRA or 401k, any savings vehicle, now would be a good time to go in, check those beneficiaries, make sure that they're updated. They reflect your views, your perspective, your life now. You know, maybe you got divorced during 2020 or something like that, and you still have an ex-spouse listed as the beneficiary of your account. So now it's a good time, the beginning of the year, to go back, all your IRA accounts, your 401k, any insurance, anything that you have a beneficiary listed, now would be a good time to review that and update it if necessary. All right, so this is a good slide for the investment class for people to, again, go back and look at their accounts, review their accounts, make sure that if they do have a beneficiary, that it reflects their current intentions, not something that's old and outdated. All right, U.S. Treasury bonds. Somebody mentioned bonds before and Treasury bonds. Basically, a U.S. Treasury bond is a debt security issued by the federal government that pays interest and principal. And the idea with a Treasury bond is that it is virtually tax-free. I'm sorry, it's risk-free. Risk-free. Why is it risk-free? Because it's backed by the U.S. government's ability to tax its citizens and print money. All right. So that's why when you talk about the safest investment in the world, it's a U.S. Treasury bond. All right. Why is a U.S. Treasury bond the safest investment in the world? It's because you don't have to worry about the interest and the principal. You know that the government, if it can never run out of money. It's just going to keep printing money. And I'm not saying that's a good idea, but in terms of being a Treasury bond investor, that's what it makes it the safest investment out there. And it's always a benchmark against which other bonds are measured. If you're getting an interest rate on a Treasury bond, then you better be getting a much higher rate of interest if you go out and buy a corporate bond or a muni bond or something like that. Why? Because there's more risk involved. All right, so volatility versus risk. A lot of people mix the two up together. The risk is probability of losing your money, while volatility is the value of the investment going up and down, fluctuating in value. Unfortunately, individuals are distracted by the short-term volatility and they lose sight of what truly matters, the risk, then in the end, they will not reach the goal. All right, so you should be more concerned about the risk of not reaching your investment goals and less concerned with the volatility. The volatility, the price is going to go up and down. There's nothing you can do about that. But you should be more concerned about reaching the objective. What are you investing for? Is this to save for college, save for a house, whatever it is? Are you reaching that goal, or what's the risk of reaching that goal? And again, I see too many people mix up the two. Investing or investors with a long-term time horizon will mitigate the risk, the market risk. All right. The longer your time horizon is, it will mitigate the risk. All right. So if you have a long-term time horizon, quite frankly, you shouldn't be concerned with the volatility at all. It shouldn't matter to you. All right. Wills, well, we're going to just skip that. And I have 3 more slides. X is for extensive expenses. Whatever you're dealing with, whether it's an investment advisor or a stockbroker, you want to check on those expenses that you're paying him. Make sure that you're not paying excessive amounts of money. Why? Because it's going to hurt your returns over the long term, all right? As with anything purchased, there are fees and costs associated with investment products and services. The fees may seem insignificant, but over time they can have a major impact on your returns. You cannot control the stock market. However, you can control the fees that you pay to advisors, mutual fund companies, etc. All right, so what I would do is I would suggest to you that if you are thinking about working with an advisor and you have to pay that person, you want to ask questions, negotiate, and shop around. You know, if somebody's saying they're going to charge you X, then maybe there's somebody else who's going to charge you a less amount. Why is that person charging me extra? Well, maybe he's performing some services that are worthwhile, but maybe he's just charging you extra money because he drives a fancy car and things like that. So be wary of the expenses that you're paying to your investment advisors, your stockbrokers, things like that. All right. Why slide? This is a fiduciary. If you're working with an investment advisor, you should be working with somebody who's a fiduciary. That advisor is legally obligated to act in your best interest. Okay. A lot of people out there incorrectly assume their advisor must act in a fiduciary capacity. That's not the case. It has to be agreed upon beforehand. And finally, the last slide is for Z, and hopefully through the lessons learned in this workshop, you will have retirement and brokerage accounts valued by a number followed by lots of zeros. And that's the whole idea of this class tonight and any of the other classes that hopefully I'll be able to teach for the Patchogue-Medford Library. All right. The idea is to learn some lessons about finances and save some money and be a prudent investor. And that way you'll have brokerage, bank accounts, IRAs, 401ks with one number, but followed by lots and lots of zeros. And that's the end, Jessica. Thank you very much. Happy to answer some questions.
Okay, so if anybody has any questions, please type them in the chat box. And also, if anybody has any ideas for more like financial presentations, just reach out and email us because we're happy to do that for you. Anything like savings or whatever you want to talk about. I have two quick questions. I don't want to be that kid that keeps the class going and everybody wants to leave, but you said a couple of times to do your homework. What kind of resources do you recommend that people can go to that are easy for them to understand to like learn more? I know you mentioned reading like Wall Street Journal and the financial section of the Times, but are there any other ones?
Well, Newsday has a pretty good, Newsday has some stuff, not really necessarily on a daily basis. On Sunday, they have a pretty good section. They cover some basic things. So at the very least, I think if you can get a copy of Newsday on the weekends, that's fine. But if you really want to read something, the New York Times has a very good financial section in that it's concise. You know, the Wall Street Journal is the best thing that you can read. But a lot of times people are like, I don't want to read the whole, the Wall Street Journal and all the different sections and such. So my suggestion to that person would be just, the New York Times has a business section. It's usually only about 3 or 4 or 5 pages. It's very concise, has what you need to know. So that's what I would do. Again, somebody who wants to start reading things on a regular basis, if they can read a daily newspaper, that's fine. And the best daily newspaper, in my mind, again, for very concise, is the Times. If you really want to go all out, then, the Wall Street Journal is the place to go. But a lot of people are intimidated by that. Again, it's a whole paper and a lot of other stuff going on. So my advice is if you have a chance, a daily paper, the journal is the best. That being said, if you don't want to, if that's a little too overwhelming, and I certainly understand that, then just pick up the Times every day. Again, 3 or 4 pages in the business section.
And shameless self-promotion, the library has both the New York Times and the Wall Street Journal available. Okay, some questions from the attendees. How to research funds that support my interests and goals. For example, if I want to invest in renewable energy stocks or funds, how do I find them?
Well, that's a good question, but there's lots of good material out there, and something called Yahoo Finance. But I think all the various internet search engines, Google, whatever search engine you would have is going to, that's where I would start. And then all you want to do in the search engine box, type in mutual funds that specialize in renewable energy or electric cars or whatever it is. That's a good place to start. So there's a lot of good information on the internet. there's also a lot of bad information on the internet, and that's why you want to be a little careful. The bad information is the stuff you're going to see in the chat rooms where people are pushing stocks and things like that. So I would not go to the chat rooms, but I would go to the general, again, the Googles, whatever search engine you use, and just type in, mutual fund that invests in renewable energy or resources, whatever it is. I think that's the place to start. And then once you have some of the names, then you want to dig a little deeper. Maybe talk to somebody in the financial services business and say, hey, listen, I'm just starting out in this. What do you think about this mutual fund and things like that? So that's the place to start. Avoid the chat rooms and things like that where people are just have their own agenda.
Okay, we have another question, which I think is more for like a retirement program. So I'm not sure if you can answer it right now, but the question is, if you leave a job, should you leave your money in the company 401k or roll it over?
Well, that's a tough question. If you have a great 401k and you like the plan sponsor, and 401ks have something that IRAs don't, and 401ks have loan provisions. So if you're the kind of person who uses a loan provision or likes to have the access to a loan, then you can do that with a 401k. Once you roll it over into an IRA, you're not going to be able to take loans against it. So it really depends on the person, what their needs are, what their objectives are. If loans are important, I would leave it with the 401k. If loans are important and you're not happy with the investment options or the service isn't that great, then I would roll it over into an IRA and have better access to the money. Anytime you have money in a 401k, you always have to go through a third party to get questions answered and things like that. Whereas if it's your own IRA, then you have much more access to it. So I think you have to dive a little deeper into that question. But hopefully, I think that's some things you want to consider. Again, the loans, if that's important to you, you probably want to stay where it is. If the investment options are good, then you might want to stay where it is. But without those things, then I think you're better off just rolling over into an IRA and having much, much, much greater access to it, most likely.
Okay, so another question. I have no idea what this means, but I'm hoping you do. Can you explain relationship between bid, ask, and trading volume?
I'll give it a shot. I mean, the trading volume is, if a stock is actively traded, then you're going to get a much more accurate price. And what that means is, let's say you go on and you have a stock like Apple, let's say, where millions and millions and millions and millions of shares are traded each day, then you're going to get a much more accurate price than a stock that's maybe that's not traded that often, that only has a few buyers and sellers out there, and they're going to be a little bit more able to dictate what the price is. So if a stock has a lot of trading volume, that's more advantageous to you. That's better off than a stock which is thinly traded. And I think a stock that's thinly traded, you're not really. I would be a little bit apprehensive about getting an accurate price. I don't know if that's the answer that person is looking for. But a stock that's traded much, much more frequently, millions and millions and millions of shares, is going to give you a much more accurate price than something that, again, is infrequently traded. I don't know. Hopefully that answer is helpful. Okay,
and as a follow-up, so the higher the volume, the narrower the bid ask.
Right, and that's the better off that you are. You're better off with a stock with a much higher volume, which a much narrower bid or ask, which means that it's a better price, it's a more accurate price. Just think about this, if you were selling your house and you had one person come to look at the sale of the house and they gave you a price, you wouldn't really be that confident that it was a good price. Whereas if you had 50 people come look at the house and they all gave you different prices, then you could kind of define a much more reasonable price, a much more a price that's more reflective of what people are willing to pay for the house. So anytime that you have more buyers, more volume is going to give you a more accurate price.
All right, and one last question, which is from me, is like, I've seen apps that are like Robinhood and stuff like that, but is that really like a good way to get started with investing, or
I don't think so. I'm sorry to interrupt, Jess, but Robinhood was in the news recently. They got in trouble because if you go on the Robinhood, they make it very easy for you to do things that aren't necessarily good investment practices, to do a lot of trading, to get in and out and things like that. And they got in trouble recently for doing that. So I would not use Robinhood. I know a lot of people are attracted to it because it has very, very low cost fees. I think some of them don't even charge you to trade, but that's the whole idea. They want you to come in and do a lot of buying and selling to use their app. So I'm not a big fan of those kind of apps, which I think encourage people to do things that aren't necessarily in their best interest. Again, a lot of trading, excessive trading, trying to time the market, getting in and out, and things like that. I think for a younger person just getting started, there are much better things out there, and you just got to do a little bit more homework. But I'm not a big fan of Robinhood. I think they tend to encourage behavior that's not good investment behavior.
Okay, and last question for real from the audience is, what are emerging markets?
Emerging markets, think about overseas, and you have Europe and Japan, and those are developed markets. And emerging markets would be China, India, countries that have much younger populations, growing populations that are looking to get cars and refrigerators and things like that. So you want to look at international and kind of break it down into two areas. The developed markets would be Europe and Japan, much older populations. Emerging markets would be countries like China, India, up-and-coming countries with much younger populations. I mean, you look at the population of China, where the many millions of billions and billions of younger people. So that's an emerging market, whereas a developed market is something, again, Europe, Asia, Japan, countries where a lot of older people, probably not as many not as much growth potential in something like Japan versus China.
Okay, thank you so much for a very informative and interesting presentation. And thank you to everybody who came out tonight. Once again, if you guys have any feedback about tonight's program, please don't hesitate to contact us. And if there are any other topics that you would like to see presented at the library on financial programs, please reach out and let us know. And thank you once again, Daniel, for your presentation.
My pleasure. And again, I have my information up on the screen, so if people want to reach out to me, speak about their personal situation, by all means, let me know. I'm happy to work with, happy to help out as much as I can.
Okay, thank you. Good night, everyone.